Look at this video. How confident he is. It's from 6 months ago. Lululemon, the easiest buy. Lululemon crushes earnings. But 6 months later, now its earnings crushing Lululemon. If you had invested in the company 5 years ago, you would be losing money today. It has not been a good investment in the past few years. But if now we look at the fundamentals of the company, and that's why I invested in Lululemon, you will see that the revenues have grown by at least 20% per year in the last 5 years, and even earnings per share have been growing over the past 5 years. If you look at fundamentals alone, it seems that the company has been doing well. So what happened in these last 5 years? Why the company is down 50% from all-time high? It's because of narratives. All investment, the market itself is built on narratives, on different stories being told by different traders, different investors. 4 years ago, Lululemon was trading at 70 times earnings. There were people willing to buy the company at this price because these people, they believed in the story that the company will keep growing its earnings and revenues at high rates. But this is not the case anymore. The revenues in the United States actually has been going down. If we don't count the new stores that they are opening. If we look at comparable sales in the US, sales have been going down. This teaches us a very important lesson. You should not be buying stocks just because everyone believes in these narratives. What we should focus on instead are fundamentals. And at 17 times earnings, we need to ask ourselves again whether it's a good time to buy Lululemon, because now it seems that the fundamentals and the price is only the weighted average of all the different stories being told about the company. Now that the price and the fundamentals are matching each other, maybe it seems that it might be a good time to buy the stock. The story now has become negative. That's why the price is down. The story has become negative because of tariffs, because the company is not growing anymore in the US, like we said, and also because in China, which is its secondary market where it has been trying to grow, it is growing, the economy there has slowed down. So we need to know if these stories are going to change in the future, and whether if these stories change, this is going to affect the fundamentals of the company in a positive way. We need to know if these negative stories will become positive in the future. And to do that, you can use CityFalcon, which I use every day. And CityFalcon is today's video sponsor. On CityFalcon, you can avoid all the noise, the different news in the market to know what you want to look for. For example, with Lululemon, you can filter the news from positive to very positive to even the very negative news or even the neutral news to know what is being said about any company in the market. I use CityFalcon every day to look at my portfolio, the different news being told about the stocks I own. If you're interested, you can have 25% off any subscription of CityFalcon using the promo code Ishfaaq. I highly recommend it. Now, let's talk about the real story of Lululemon. The real story are backed by fundamentals. When we look at why the revenues of Lululemon are growing, it's simple because they are expanding in China, they are expanding in Europe. So this is a good story that if they keep expanding in these countries, because the brand is so strong, there is competition in the US, but the competitors are not that famous yet in China. They are not that famous yet in Europe, where Lululemon is expanding rapidly. There they are really competing with Nike, with Adidas, but these companies are not really as premium compared to Lululemon. So they are entering a completely new market where there is little competition so far. The competition might be here in 5 years, but it's not here right now. The competition is mostly in the US. So there is the possibility of Lululemon keeping expanding, growing at a rapid rate without needing much capital for that, without needing much expenses for that. Speaking about expenses, Lululemon has the same gross margin as a company like Google. So we need to ask ourselves why. Why is this possible? Why compared to Nike, they have gross margins of 60%. Even the operating margins of the company are so great. It's because they don't have the wholesale model that Nike has. They are vertically integrated. Actually, according to the founder of Lululemon, the idea for Apple stores, Steve Jobs got that idea from him. I don't know if it's true or not. They have been selling their products in their own stores before Apple. And they have been doing that better than the competitors. When Lululemon are talking about direct to consumer, With other companies, direct to consumer means selling directly to consumer in their own stores or online. For Lululemon, it means only online. Another way that this company is different from competitors is the way they market themselves. You will see Nike, Adidas, they're partnering with all these superstars. You have to pay these people. But Lululemon, they are partnering with local individuals. For example, there is a gym in a small city, so it's a popular gym. They go and meet the people operating the gym, okay, give them some shirt from Lululemon, and this is how they market themselves. And with such a business model, they can generate a lot of cash with little capital requirement. Excess cash is being returned to shareholders through buybacks. Okay, this looks like a great story. So should we be buying Lululemon at this price? Actually, at this price, I believe it is fairly valued. And this is the mistake I made with Lululemon. I overpaid for it. I always say that when it comes to consumer discretionary, when it comes to fashion, I like to take a big margin of safety. I like to be careful. I did that with Crocs, and with Lululemon too. I tried to do that, but I did not do it so well. There are things that I overestimated. There are places where I was over-optimist. When it comes especially to a company that is where most of its value is derived from growth. With Crocs, in my calculation of the intrinsic value, I don't take into consideration any growth at all. So there is a big margin of safety. If the company grows, good. This is a bonus. I'm very happy. I wasn't looking for it, but I'm happy. I hope it is going to grow. With Lululemon, this is not the case. When I value the company, I put a lot of emphasis on its ability to grow in China, in Europe. So I was paying for uncertainty, and I overpaid for that. So if we look at Lululemon compared to the competitors, I will say that it is the best. It is the best. They have the best fundamentals. But if compared to everything else in the market, I could have done better. There were better alternatives in the market. When the stock was trading at $230 a share a few months ago, then it was at a great price. And I love the fact that I bought at this price. But I'm not happy that I kept buying while the stock price went up. This is the mistake I made. It's not something that you can avoid. Of course, it's good that you are going to learn your mistake as an investor, and I hope not to do the same mistake in the future. But this is not something that you are going to avoid. Any great investor after 20 years, 40 years of investment, you're going to overpay for something. It's bound to happen. But as long as the good decisions you make vastly outperform the bad decisions you make. It's not here, the bad decision is not really about investing in a bad company, which I have done in the past, and to understand how I managed to make so many bad mistakes in the past, yet beat the market over the long term, making 10x returns on my portfolio in just 8 years. I would recommend you watch this video next. Have a nice day and goodbye.